Good morning, and welcome to your market update. Today's session is being driven by a remarkable rebound in risk assets, powered in large part by a blowout earnings report from Nvidia that's reigniting optimism around the AI trade. The company reported fiscal Q3 revenue of about $57 billion, up roughly 62% year-over-year, with its data center business leading the way. Nvidia also raised its Q4 forecast to around $65 billion, signaling strong ongoing demand for its Blackwell generation GPUs. CEO Jensen Huang pushed back on fears of an AI bubble, saying demand remains off the charts across all phases of AI. That earnings beat has sparked a relief rally in global markets. U.S. futures are sharply higher, and investors are rotating back into tech. However, not everyone is letting go of valuation concerns. Some analysts warn that despite the strong execution, the broader question of sustainability remains: are we truly in a virtuous AI cycle or just riding tech exuberance? On the macro front, interest rate expectations remain in flux. According to recent Fed minutes, policymakers are divided on further cuts, and the delayed release of the U.S. September jobs report adds more uncertainty to the outlook. This tension underscores a delicate balancing act: the desire for looser monetary policy to support growth, weighed against the risk of fueling excessive inflation or speculative bubbles. Adding to the macro story, Barclays issued a bold call. In its 2026 outlook titled, "As Goes AI," the firm raised its S&P 500 target to 7,400 from 7,000. Positing that AI is now the dominant long-term macro force, more important than traditional levers like monetary policy or trade. Barclays argues that fears around a bursting AI bubble are overstated, and that long-term AI capital expenditure could continue to drive growth across sectors, including tech, telecom, and infrastructure. Still, caution isn't dead. Some strategists point out that current valuations in big tech remain rich, and concentration risk, with a few major names carrying a disproportionate share of market moves, continues to weigh on sentiment. For those building or rebalancing portfolios, this is a moment to think carefully. Do you lean into AI strength or hedge against potential froth? What this means for investors. Growth investors might consider leaning into core AI plays, especially hardware and infrastructure providers that are directly benefiting from data center demand. Risk managers may want to watch earnings closely and assess exposure, perhaps using options or diversification as a way to guard against a potential pullback. Long-term investors should consider the broader macro trend. AI could be a secular force, but it's not immune to policy risk or valuation re-rating. Good morning, and welcome to your market update.